Welcome, investors. Have you ever wished you could hit the reset button on your investment journey? Maybe you're just starting out and feel overwhelmed, or perhaps you've been investing for years but suspect you're not doing it right, possibly burdened by high fees or complex strategies you don't fully understand. Many of us have been there, including myself. The good news is, it's never too late to take control and build a robust investment portfolio designed for long-term success. Today, we're going to simplify the process, focusing on how you can construct a low-cost, diversified portfolio using exchange-traded funds, or ETFs, from the ground up. This isn't about chasing hot stocks, it's about building a foundational strategy that stands the test of time, giving you confidence in your financial future. So, why the emphasis on low-cost ETFs? Historically, many investors relied on actively managed mutual funds, often incurring significant management expense ratios, or MERs. These fees, seemingly small at 1% or 2% annually, can erode a substantial portion of your returns over decades. ETFs, particularly index-tracking ones, typically boast much lower MERs because they simply aim to replicate the performance of an underlying index, rather than actively trying to beat it. Furthermore, a single ETF can give you exposure to hundreds or even thousands of individual stocks or bonds, providing immediate, broad diversification. They trade like stocks throughout the day, offering flexibility and transparency that many traditional mutual funds lack. This combination of low cost and broad diversification makes ETFs an incredibly powerful tool for the modern investor. Before you even think about buying your first ETF, the single most critical step is to define your investor profile. This isn't just a formality, it's the compass that guides all your investment decisions. Your investor profile helps you articulate your financial goals. Are you saving for retirement in 30 years, a down payment in 5, or something else? It determines your investment time horizon. The longer your horizon, generally the more risk you can afford to take. Most importantly, it assesses your risk tolerance. How comfortable are you with market volatility and potential temporary losses? Online questionnaires, often provided by brokers or financial institutions like the one referenced from BMO, can help you clarify these aspects. Knowing your profile is crucial because it directly informs your ideal asset mix, the proportion of stocks to bonds in your portfolio. Once you understand your investor profile, the next fundamental principle is diversification. Think of it as not putting all your eggs in one basket. A truly diversified portfolio minimizes risk by spreading your investments across various dimensions. This includes different asset classes, primarily stocks for growth and bonds for stability. It also means geographic diversification, investing not just in your home country, but also in the US, international developed markets, and even emerging markets, to capture global growth opportunities and buffer against regional economic downturns. Sector diversification, avoiding overexposure to a single industry, is another layer. By diversifying broadly, you reduce the impact of any single underperforming investment and enhance the overall stability and long-term return potential of your portfolio. It's a smart, battle-tested method for lowering overall risk exposure. With your investor profile defined and the principle of diversification in mind, we arrive at the concept of your core portfolio. This is the bedrock of your financial future, designed for long-term growth and stability. Your core should be composed of investments that provide broad, diversified exposure to various markets and asset classes, aligning perfectly with your risk tolerance and time horizon. We achieve this foundation using low-cost index ETFs. These aren't funds that try to pick winning stocks, they simply track the performance of a specific market index, like the S&P 500 or the TSX. This passive approach often outperforms active management over the long run, primarily due to lower fees and consistent market exposure. Establishing a strong core ensures you participate in overall market growth without the need for constant, stressful adjustments. The backbone of your core portfolio is your asset allocation, specifically, the ratio of stocks to bonds. Stocks, representing ownership in companies, offer higher growth potential over the long term but come with greater volatility. Bonds, essentially loans to governments or corporations, typically provide stability, lower volatility, and regular income, though with lower growth potential. Your investor profile, particularly your time horizon and risk tolerance, is paramount here. For a young investor with a long time horizon and a high risk tolerance, an aggressive mix like 80% stocks and 20% bonds might be suitable, aiming for maximum growth. As you approach retirement or become more risk-averse, you might shift towards a higher bond allocation. The key is to find the balance that allows you to sleep soundly at night while still pursuing your financial goals. For Canadian investors, having exposure to the Canadian stock market is a natural and often beneficial part of a diversified portfolio. It allows you to participate in the growth of your local economy and benefit from familiar companies. The Canadian market, typically tracked by an index like the S&P/TSX Capped Composite, is heavily weighted towards certain sectors, notably financials, energy, and materials. While these sectors offer unique opportunities, their concentration means relying solely on Canadian equities could leave your portfolio less diversified than desired. Therefore, while a Canadian equity ETF, such as BMO's ZCN or iShares XIC, is an excellent core component, it should always be viewed as part of a broader, globally diversified strategy to mitigate sector-specific risks and capture opportunities beyond our borders. While Canadian equities are important, true diversification demands a global perspective. The U.S. stock market, home to many of the world's largest and most innovative companies, is indispensable for any growth-oriented portfolio. An ETF tracking the S&P 500, like BMO's ZSP or Vanguard's VOO, gives you exposure to these giants. Beyond North America, international developed markets in Europe, Asia, and Australia offer further diversification across different economies, industries, and currency fluctuations. An ETF tracking a broad international index like the MSCI EAFE, such as BMO's ZEA or iShares XEF, ensures you're not missing out on growth opportunities from around the world. Neglecting these markets would mean missing a significant portion of global economic activity and limiting your portfolio's potential for robust long-term returns. To further broaden your equity exposure, consider a small allocation to emerging markets. These are countries like China, India, Brazil, and many others in various stages of rapid industrialization and economic development. Investing in emerging markets offers the potential for higher growth rates compared to developed economies, driven by younger populations, expanding middle classes, and technological adoption. However, this potential comes with increased volatility, liquidity challenges, and unique geopolitical risks. An ETF tracking an emerging markets index, such as BMO's ZEM or Vanguard's VEE, can provide this exposure. Given their higher risk profile, most investors allocate a smaller percentage of their equity portfolio to emerging markets, treating them as a satellite component within their broadly diversified core, carefully balancing the growth opportunity with the inherent risks. Shifting from growth to stability, the fixed income portion of your portfolio, primarily bonds, plays a crucial role. Bonds are essentially loans, and they typically offer lower returns than stocks but also exhibit significantly less volatility. Their primary function is capital preservation, providing a steady stream of income through interest payments, and acting as a ballast against the swings of the stock market. During periods of equity market turmoil, bonds often hold their value or even increase, helping to mitigate overall portfolio losses. For comprehensive fixed income exposure, consider ETFs that track the broad Canadian bond market, like BMO's ZAG or Vanguard's VAB, and potentially the U.S. bond market, such as BMO's ZAG or iShares ZUB, providing diversification across government and corporate debt. This blend ensures a robust, stabilizing force within your core portfolio. Here's a fantastic pro tip, especially if you're just starting out or prefer a truly hands-off approach: consider asset allocation ETFs. These are often called one-fund portfolios for a reason. Instead of buying individual ETFs for Canadian stocks, U.S. stocks, international stocks, and bonds, an asset allocation ETF holds all of these underlying ETFs within a single fund. They are designed to maintain a specific asset mix. For example, a growth asset allocation ETF might target 80% stocks and 20% bonds. The magic doesn't stop there. These funds also automatically rebalance themselves quarterly or semi-annually, ensuring your portfolio stays aligned with its target allocation without you lifting a finger. This level of simplicity, combined with broad diversification and low costs, makes them an incredibly appealing option for many investors, including offerings from providers like BMO or Vanguard. Even with a perfectly built core portfolio, markets move, and your asset allocation will drift over time. This is where rebalancing comes in. Rebalancing is the process of buying or selling investments within your portfolio to bring it back to its original target allocation, such as that 80% stocks, 20% bonds mix. For example, if your stocks perform exceptionally well, they might grow to represent 85% of your portfolio, making it riskier than you intended. Rebalancing would involve selling some stock ETFs and buying bond ETFs to return to your 80-20th target. This disciplined approach ensures you maintain your desired risk profile, and it can even be a buy low, sell high mechanism by trimming outperforming assets and adding to underperforming ones. While asset allocation ETFs handle this automatically, if you're building with individual ETFs, aim to rebalance annually or semi-annually, or whenever an asset class deviates significantly from its target. Now that we've established the robust core of your portfolio, let's talk about adding a little spice, the core and explore strategy. This approach recognizes that while a diversified core is essential, some investors also want the flexibility to pursue higher risk, potentially higher reward opportunities. The core and explore philosophy suggests keeping the vast majority of your portfolio, typically 90 to 95%, firmly in your established, low-cost, diversified core ETFs. This ensures your foundational wealth building remains on track. The remaining 5 to 10% is your explore budget, a dedicated portion for investments that might be more speculative, less diversified, or simply areas you have a particular interest in, like individual stocks or alternative assets. This structured approach prevents exploring from jeopardizing your core financial stability. What could be part of your explore portfolio? One common option is investing in individual stocks. Perhaps there's a company whose business model you deeply understand and believe has significant growth potential, or a specific sector you're bullish on. The explore portion allows you to back your convictions directly. However, it's crucial to remember that individual stocks carry significantly higher risk than a diversified ETF. A single company's fortunes can shift rapidly, impacting your investment much more dramatically than it would affect a broad index fund. Therefore, comprehensive research, understanding the company's financials, competitive landscape, and future prospects is paramount. This isn't about guesswork, it's about informed speculation within a controlled, smaller portion of your overall wealth, distinct from your core foundational strategy. Beyond individual stocks, your explore allocation can also venture into alternative investments or niche assets. This might include precious metals like gold, often seen as a hedge against inflation or market uncertainty. Real estate investment trusts, or REITs, offer exposure to various property types without direct ownership, providing income and diversification. And yes, for those with a high risk tolerance and a deep understanding of the underlying technology, even a very small, carefully considered allocation to cryptocurrencies could fit here. However, it's imperative to stress that these assets often come with their own unique risk profiles, which can be significantly higher than traditional stocks and bonds. They may also be less liquid or harder to value. The explore bucket is where you can experiment, but only with capital you are entirely comfortable losing, and always underpinned by solid research and a clear understanding of the risks involved. This is definitely not for everyone, and I personally err on the side of caution for these volatile assets. The explore portion of your portfolio is about calculated risk, not reckless gambling. The cardinal rule is to never let your explore activities jeopardize your core financial foundation. This means the 5 to 10% allocation is a hard limit, and you should only invest capital in this segment that you are genuinely prepared to lose. High-risk investments can, and often do, experience significant drawdowns. Beyond the capital limit, rigorous risk management involves deep personal research into every asset you choose for your explore bucket. Understand its fundamentals, its market, and its potential downside. Avoid hype and make decisions based on data and a clear thesis, not emotion. This disciplined approach ensures that your desire for exciting growth doesn't derail your long-term financial security. Let's pause for a powerful statistic that underscores why consistent, long-term investing in your core matters: the power of compounding. Albert Einstein reportedly called compounding the eighth wonder of the world. It's the process where your investment returns generate their own returns, creating exponential growth over time. For example, if you invest $10,000 today and earn an average of 7% annually, after 30 years, that initial investment would grow to approximately $76,000. If you added just $100 per month, that total could exceed $120,000. This seemingly magical growth emphasizes that consistency and time are your greatest allies. It's not about timing the market, which is notoriously difficult, it's about time in the market, letting your money work for you, steadily building wealth year after year. Feeling empowered? Excellent. Here are your immediate actionable steps. First, take the time to thoroughly define your investor profile. Understand your goals, time horizon, and true risk tolerance. This is non-negotiable. Second, decide how you'll build your core portfolio. Are you comfortable selecting individual ETFs for each asset class and region, or does the simplicity and automated rebalancing of an all-in-one asset allocation ETF appeal more? Both are excellent, low-cost options. Finally, the most important step, start investing consistently. Set up automated contributions to your investment account. Even small, regular investments harness the power of compounding over time. Don't let perfection be the enemy of good. The best time to start investing was yesterday, the second best time is now. To recap, we've walked through the essentials of building a powerful investment portfolio. Start by knowing yourself through your investor profile, then construct a strong, diversified core using low-cost ETFs across various asset classes and geographies. If you wish, augment this with a small, disciplined, explore allocation for higher risk opportunities, always remembering to protect your core. This systematic approach demystifies investing, moving you away from high fees and complex, underperforming strategies towards a clear path for wealth creation. Remember, investing is a marathon, not a sprint. Consistency, patience, and a well-defined strategy, like the Core and Explore framework, are your most valuable assets. You have the knowledge now to empower your financial future. Thank you for joining me, and here's to your successful investing journey. Thank you for watching. If you liked this video, please like and subscribe.